Welcome, everyone. So last week the federal budget was handed down. A lot was in it, and today we're going to be joined by Matt Battye to discuss the highlights and an overview of the budget.
Yeah, okay, thanks. You're right, there was a lot in it. Budgets, I remember once upon a time, pretty much every year I'd sort of sit down and watch the budget live and just sort of see what happens, and then it got to the point where there just wasn't a lot in them, not a lot of point, to be honest. But this one I did watch for the first time in many years because I suspected there would be a bit. But even I was very surprised by just the amount of measures that the government announced. So often in recent years the budget's more been re-announcing than new things, but this one really did have quite a lot in it. So what we might do today is just really go through some of the highlights and a little bit of the detail, and obviously there'll be resources available if people want to sort of delve into more. But one of the things always to keep in mind with budgets and these sorts of announcements is that at this stage they're just announcements. There's nothing legislated. You've got to go through the process, and especially with the COVID situation and limited sitting days in Parliament, some of these things might take a while. But generally speaking, I think it's fair to say that there'll be a lot of bipartisan support because the opposition and other parties won't want to be sort of seen to be the ones holding back money. So this is a big spending budget. This is like the mother of all pre-election budgets, even though there isn't an election coming up. So let's start with the big one, taxes. There was some not so much tax cuts per se, more of a bringing forward of the tax cuts that the coalition had already announced. So there was already some legislated tax cuts to occur over the next years, basically going out to sort of 2025, for the 2025 year, and they've rolled some of them forward. So and really backdated it. So I think it's the first time, certainly that I can remember, where a government's backdated something that increases your benefit. Normally they backdate something to stop you taking advantage of a rule change. And so what that really means is everyone will get a pay rise this year, in the sense of some of the tax that's already been withheld will have been a bit too much, and so everyone's going to get a refund. Now, the downside to that is it'll be the end of the year when you do your tax return, because it's just way too complicated to try and work it out and redo it through the PAYG system along the way. So everyone will have prepaid a little bit of extra tax. That's the first thing. And so really what that means is probably the big difference is they're now the upper limit of the 19% tax bracket is going to move up to $45,000 for next year, and then the 32.5%, which was $90,000, is going to go up to $120,000 now. And the next range, which is the 2024-25 year, essentially there'll be the flattening of those rates. So we'll have essentially a 30% bracket all the way up to 200,000, and then 200,000 above will be the 45. So there'll be less brackets and a bigger spread. So that's going to have a big impact in terms of tax planning. So people who are coming close to retirement, people who are realising capital gains, people who have investment companies or family trusts and doing those distributions, that's going to change your tax planning a little bit. So that's probably the first and foremost to think there. There was a lot of support in this budget, a lot of, let's call it kind of welfare spending, in that sense of, JobKeeper and Job Seeker payments and the COVID payments and the extensions of those out until December, albeit at a sort of half the rate they were before, pretty much. So there's some more payments to pensioners this time, $250, sort of a one-off. So pensioners will get it, and there's some other eligible recipients as well, but there's a little bit of extra cash. Not as much as there was the first time around, but there is a little bit of extra money coming. And again, this is the government really just trying to put money in the hands of people most likely to spend it, to try and sort of help kickstart the economy. So, because that's really what this budget was, I guess, designed around. The government was sort of saying, okay, well, let's grow our way out of this problem. And so how do we kickstart the economy as quickly as possible? And so that's really focusing on jobs. So there was up to a couple $100 a week for employing young Australians, because they've been disproportionately affected by the shutdown. A lot of sectors that young people, and especially women, the sort of areas where they are disproportionately represented in the workforce, they were also the most disproportionately affected. So there's been a lot of measures for, getting those people back into work or starting them off. So including up to, half the wages for new apprenticeships. The government's looking to fund up to about 100,000 new apprenticeships and traineeships. Well, they cover up to half the wages for 12 months. So if you're an employer or potentially an employer over the next sort of 12 months, there's a really good opportunity potentially for you to get some really good support for bringing in some young talent sort of thing. So, and with small businesses, there's an extension then of the instant asset write-off. Essentially, you'll be able to bring forward tax deductions. So we've seen that again last year. So I won't go into a lot of detail around that. It's relatively complicated, but fair to say if you've got any equipment, you've got any major sort of expenditures, you won't have to depreciate that over its normal useful life. You've got to kind of write it off in 1 year. So just keep bringing those tax deductions forward so that businesses have more profit, have more cash flow, and they can reinvest. And in particular, if you've got, if you can, if you're the sort of business that does have the opportunity to invest some capital in, particularly for growth or maintenance or replacement equipment, you're going to get an acceleration of those tax deductions to do so. So, housing, they're going down the first home owner scheme again. Not much really to say about that other than they're trying to get more people into the loan deposit scheme. So, to help, the construction industry is obviously the idea behind that. Some of the things, and just while we're talking still relatively positive things, one of the things I thought was very potentially a very good shift or a continued move in sort of the home care subsidies as well. So rather than sort of, as you can imagine, the COVID scenario hasn't really shone a great light on, aged care facilities. So one of the things the government's doing, they're putting out about a $1.6 billion budget towards sort of home care packages, and they're expecting about sort of 23,000 increase in new packages for people who are being basically supported at home rather than everyone having to go into an aged care facility sort of thing. So we know that can have a lot of benefit for people because they get to stay in an environment and around people that are much more conducive to a sort of happier life. And the other thing it does is it doesn't sort of put everyone in the one location sort of thing, which again, part of the issue with COVID is we had that sort of concentration of susceptible people in the same sort of location. So and the other really interesting thing, which is sort of an extension of that, is they've announced some targeted capital gains tax exemptions for granny flats. So granny flats have been one of those things in the past where, because it's an income-producing asset or a proportion of you, it's a bit like having a home office. As soon as you have an income proportion part of your property, some of your property now, percentage of property now, isn't exempt from capital gains tax under the primary residence exemption. So that can often be pretty complicated, and it's not really a disincentive, but I guess it could act as a partial disincentive for those sorts of arrangements. And in recognising that, generally speaking, it's often good to have, older people, within the family unit around that, putting granny flat out the back and accommodating that sort of environment without suffering a financial penalty essentially for doing so, because you're not going to pay capital gains tax on that. So that again, those two measures in particular with the home care and the granny flat arrangements should, I think, be very positive in helping people have, more conducive sort of healthcare arrangements. The other probably big one that has the potential to affect people a lot is some of the changes around super. So they've sort of said from now on your super fund will follow you. There's none of this sort of setting up a new super fund every time you change employment, which was something that's been available for a very long time, but in the sense that you could always take your fund with you, but it was something really you had to kind of elect to do. Right. Whereas many employers, just for simplicity, would just simply say, "Oh, we have this arrangement because we have to make super contributions for you." So rather than you wait to tell us, we'll just set up whatever's easy for you, and that's your problem. Whereas now the government sort of flicked that switch a little bit and said, "Okay, well, we'll stop doing that because you just end up with all these small accounts." And especially young people work 5 jobs sort of thing, and over time they just end up with all these small balances. Will automatically make you have to, they'll be just part of the organisation as part of your HR. So that's a positive thing. But one of the other things they're going to bring in is, they've talked about this for a little while, about this concept of having kind of like almost like a leagues table of super funds. One of the things that they're concerned about is that there's always some underperforming funds, and so how do we consolidate those? And the industry hasn't found a way to do that fast enough. So the government's looking at ways to sort of accelerate that. And one of the ways they think they can do that is having kind of literally like a comparison site. Right. To say, okay, well, your fund will be on this comparison side and all the funds will be on there, and they'll report their returns and features and benefits or whatever. That's the details not out yet, but essentially the inference is around there'll be league tables of performance, and that will help to expose underperforming funds. Right.
Because past performance is indicative of future performance. Is that how it works?
Well, so here's the thing, right? So it's not a bad idea, right? In the sense of, sure, if you're in a fund that over the long term underperforms another fund, you end up with less money than had you been in that fund. Okay. However, there's a few problems with that. First of all, we have this thing called the distribution curve, right? And it's a thing for a reason, is that in theory, if every fund invested the same way, they'd all get the same return. But then that would be to the detriment of the potential of returns, because now the market only has one return, and the only way you can get that is everyone investing in the same thing. And if we get invested in the same thing, then there's no capital for variability of ideas. So you're just not going to get that. You're just not going to get this really narrow range of returns when you're allowed to invest in a very broad range of things. Okay. In the long term, it turns out you tend to do that, right? We know that strategic asset allocation, so where your money's invested, not how necessarily it's invested within that sort of asset class, is by far the biggest driver of returns. So really, the vast majority of the highest performing long-term super funds, like any investments, they're just more growth. Okay, now, they might define it a bit differently. We've got some very interesting things in recent years where, the various funds have sort of been taken, not really taken to us, but at least the light's been shone on to say, look, you call yourself a balanced fund, and you're saying you're doing better than fund XYZ over here, which is also a balanced fund. But you've got 70% of your money in shares and 20% of your money in unlisted infrastructure, right? And they got 50% of their money in shares and 50% in cash, and you're both calling yourself balanced. You're 90% growth, and you call yourself balanced, so you go on the same table as a bloke who's 50% cash. Well, of course your return's going to be completely different, right? So, in fact, sometimes they're going to be a lot better because the market was really volatile. So there's, I guess the short thing here is, no matter what, someone's going to try and game the system, right? So trying to put a short-term pool, and it'll be something like that. It'll be a 3 to 5 year time frame, whatever. But as you can see, and we've got some videos on this, everyone check them out on how to game those sorts of things, and marketers try to do this all the time. Yeah. And they do this not necessarily by telling lies, but by picking the data that suits the story, right? So anything that's volatile can be made to look really good or really bad depending on when you want to pick. Yeah. And so that's one of the things, that's one of my big concerns with this, is it's going to be very, very easy for funds to look good for short periods of time to try and game that. And so what you're going to do is you're going to have funds chasing performance as opposed to chasing long-term performance, right? Because anything beyond that short term is not going to matter. It's not going to drive your FUM. It's not going to keeping out of the bottom is what you're going to want to do. Okay, now the reality is the only way to keep out the bottom is to chase the top. Okay, and the more you chase the top, the more likely you are to end at the bottom. That's just the basic math of it. And so, yes, it's the right idea. You do want to get rid of those underperforming, but that's just information. Just make sure people are aware of it, would be my suggestion. And so, sometimes the best performing funds are about to be the worst. In fact, most often. And the worst performing funds, and again, keeping in mind that a super fund is rarely a single thing. I mean, if you just let everything go into the default balance fund, well, of course you're going to get what you're going to results relative to the effort you've put into checking it, sort of thing. Whereas if you're actually constructing a portfolio, in the long term, there's not a huge difference between a really well-run portfolio that I put together versus a really well-run portfolio that you put together. How and when you accumulate and the tax you pay and the strategy you apply around that's going to make a much bigger difference. Well, certainly predictable difference, because again, there's going to be a little bit of variation over time, and there's no way really to predict that. Whether you should have held a bit more Microsoft versus Amazon or those sorts of things, that's not the big driver of wealth. Did you put enough away is a far bigger predictor. So it's one of those things that it's a good idea. It'll be really interested to see how it, and even if it can be implemented. So that's probably something that's going to it's probably going to drag out for some time. But look, not a huge measure in the sense of it's not really going to affect where we're coming from a COVID recovery sort of perspective. Yeah. So the question I get asked all the time is, was it a good or a bad budget, right? And I'd say on the whole, this one's pretty good in the sense that it's the right focus, right? It's similar. It reminded me a little bit of the GFC, right? When we came out of the GFC, and as sort of a cash splash at that sort of point as well. But what Labor did at that point in time is they talked the infrastructure and long-term game, but that's not really what they delivered, sort of thing. So this is very different circumstances to the GFC. But what the government, the coalition have basically said is we're going to grow out of this, and we're going to target mostly focusing on what we call the velocity of money. We're going to give money to people who spend it, which is a good idea because velocity is important because one person's spending another person's income sort of thing. But what you got to be really careful and make sure that you put into your spreadsheet when you're doing these calculations is velocity alone doesn't matter. Velocity only matters if there's value generation in that exchange. So me giving you $100 for something, then you give me $100 for something, and I give you $100 something, backwards and forward, backward doesn't do anything.
Yep.
Me taking the $100 and doing something that's meaningfully valuable, and vice versa, that's how money grows. And then the velocity of money matters. If there isn't that growth, isn't that productivity, we're not creating value, then the velocity really is a shell game sort of thing. So they have targeted small business. They have targeted the areas of the economy that are likely to generate that return. So that's, I think, a really positive thing, rather than big, grand infrastructure ideas that will take 10 years to get off the track and probably won't. Not that those things aren't important, but they're not the solution during these sorts of periods of time. So continued support for lower income people. That trend, as I was talking about, for looking at aged care in a more holistic sense with the granny flats and those sorts of things, they're the really good things. The bad, we're going to tickle $1 trillion debt, right? Which I remember when the US started to hit that, and that was a bad number for the US, which is a much, much larger economy than ours. So that's going to be very, very interesting. There's a lot of monetary policy issues around that as well as fiscal. So that's something to really keep an eye on. And yes, you can grow your way out of it, but we're talking about unprecedented levels of government spending on government debt. So at a time when the whole world's going through the same thing. So that's going to have some interesting asset allocation, investment decisions. It means just buying an index and sitting around and watching that go up is almost certainly not going to work like it's worked for long periods of time over the last 20 years. There's a lot of uncertainty still left, in terms of the political response to, we're still locked down to a fair degree. Victoria's very locked down. There's areas of the world that are very unlocked down and right through to quite locked down. So, and we don't yet know how governments are going to respond to spikes, second and third and fourth waves, and will vaccines work? Will they really be here anytime soon? A lot of those things are so they're the uncertainties, I suppose. There's plenty of uncertainties with this, but all in all, I'd say it's pretty good. A pretty good response given the circumstances. So if you're a small business, now's the time to grow. A lot of great business. I know you've mentioned this to me a number of times. These sorts of periods of times where a lot of great businesses are spawned, and a lot of businesses do quite well. And the other thing I'd say, pre-retirees. So if you were thinking of retiring in the next sort of 3 to 5 years, the tax changes alone with this is going to change your strategy quite significantly. So some good forward planning for sort of the next 3 to 5 years is a really good idea if you're going to go through that transition, because there's a lot of changes with those levels, etc. That means there's a lot of extra opportunity. So small business and pre-retirees are probably the ones that need to do the most planning sort of coming out of this.
Yep. Brilliant. All right. Well, there's a lot you touched on there, Matt. So thanks very much. And as always, if people have got any questions, they can give the office a call or speak to your advisor.
Absolutely. Thanks very much.